Welcome back to the Deep Dive. It is Tuesday, February 10th, 2026. Today, we have a massive stack of documents on the desk. We are looking at the Q4 and full year 2025 results for Royal Philips.
Yep.
Plus, and this is the juicy part, the strategic roadmap they just dropped at their Capital Markets Day.
And this is the first time in about 3 years where opening a Phillips report doesn't feel like, well, performing an autopsy.
That is dark, but I have to say, it's entirely fair. If you've been following the healthcare space, you know Philips has been in the absolute trenches. You had the massive Respironics recall, the supply chain collapse, the consent decrees. I mean, it has been a rough ride.
A very rough ride.
But looking at these papers today, the narrative they are pushing is growth acceleration. So the question is this a real turnaround, or is it just clever accounting?
I think it looks real, but it is complex. We aren't just looking at a good quarter. We are looking at a fundamental shift in how they make money.
But shift how?
They're moving from a company that just sells boxes to a company that sells platforms, and they are, I think, finally shedding the dead weight of those crisis years.
So let's pressure test that. We need to parse the financials, the new tech stack, and this new 3-year plan. Let's start with the vital signs. We're looking at Q4 of 2025. How did they close the books?
They closed with a sprint. I mean, if you only looked at the first 9 months of 2025, you'd see a company just, plodding along, barely keeping its head above water.
Right.
But Q4, comparable sales growth hit 7%. They recognized 5.1 billion euros in just those 3 months.
7%. That's a big number for a mature industrial conglomerate. Usually you're happy with 3 or 4.
It is huge. And context is key here. For the full year of 2025, comparable growth was only 2%. Total sales were 17.8 billion.
So the entire growth story for the year is really built on this fourth quarter explosion.
Exactly.
Okay, but revenue is vanity, profit is sanity. It's easy to sell 7% more if you discount everything. Did they actually make money on that sprint?
They did, and this is probably the most important takeaway for anyone trying to understand their business model right now. It's not about the sales volume, it's about the operating leverage.
Okay.
Their adjusted EBITDA margin for Q4 hit 15.1%. That is a 160 basis point jump year over year.
Let's pause there. For the listener who isn't a CFO, 160 basis points sounds small. That's 1.6%, right? Why is that massive?
Right, 1.6%. In industrial healthcare manufacturing, margins are a game of inches. So moving from roughly 13.5% to 15.1% is a huge leap in efficiency. It means for every euro they brought in, they kept significantly more of it.
And they didn't get that just by selling a few more toothbrushes.
No, not at all.
So how did they get it then?
By cutting costs relentlessly. This is the productivity story we've been tracking for a while. Philips had a target to cut 2.5 billion euros in costs over 3 years.
Yeah.
As of this report, they hit it. In 2025 alone, they stripped out 0.8 billion euros of structural cost.
So they're running a significantly leaner machine. They've trimmed the fat. But I have to play devil's advocate here. I'm looking at the cash flow statement, and something isn't adding up.
I think I know what you spotted.
Q4 free cash flow was 1.2 billion euros, which looks great, but the full year free cash flow is only 512 million on nearly 18 billion in revenue. That conversion ratio is terrible. Where did the cash go?
You caught the ghost in the machine. This is where the past comes back to haunt the present. Operationally, the business is a cash cannon. That 1.2 billion in Q4 proves it.
Right.
But 2025 was the year they had to pay the piper. That low full-year number includes a massive outflow over 1 billion euros, specifically for the Respironics recall settlements in the U.S.
Right, the sleep apnea devices. We're talking about personal injury settlements, economic loss claims.
Exactly. That 1.025 billion euro payment went out the door in 2025. If you mentally add that settlement money back in, the business generated 1.5 billion in free cash flow, which is very healthy.
So the business works, but the lawsuit bill came due.
Precisely. And you can't ignore it because it's real money leaving the bank. It's a stark reminder that while the operations have turned a corner, the balance sheet is still digesting the sins of the past. It's like a legacy tax they are still paying.
Okay, so that's the scorecard. Leaner, profitable, but paying off old debts. Let's pivot to the growth engines. Where did this 7% Q4 growth actually come from? I assume the hospitals are finally buying MRIs again.
You would assume wrong. The star performer, honestly, somewhat shockingly, was personal health.
The consumer stuff. You mean Sonicare toothbrushes? Norelco shavers?
Up 14% in Q4.
Wow. I feel like every headline I read says consumer spending is soft globally. How did they pull double digits?
It's largely thanks to the China rebound. You have to remember, the comparison base, meaning where they were in late 2024, was pretty low. But specifically, Chinese consumers seem to wake up in Q4 2025.
Oh.
Philips saw double-digit growth in their growth geographies, and that was driven heavily by China.
Is that sustainable, though? Relying on Chinese consumer sentiment feels a bit risky right now, given the economic climate there.
It is risky, but they aren't just relying on macroeconomics. They're executing really well on product strategy. Look at the One Blade platform.
The electric shaver that looks like a razor, I see ads for that everywhere.
Right, but notice the language in the report. They aren't calling it a shaver anymore. They are expanding it into an all-body solution.
All-body solution. Okay.
It sounds like marketing fluff, but it's actually a brilliant business move. They're taking a winning product and expanding its use case. Instead of just selling you a faceblade, they sell you a body kit, an intimate grooming kit.
So they're turning a grooming device into a platform ecosystem.
Exactly. It increases the lifetime value of every customer because you keep buying different specific blades.
The classic razor and blade model, literally.
Literally. And it's working, so personal health is booming.
What about the B2B side? Connected care. This is the hospital monitoring stuff, right?
Right. And this is where the strategy gets really interesting. Sales were up 7%, and margins hit a robust 16.5%. But ignore the quarterly wiggle for a second. Look at the deals. They highlighted a 5-year strategic partnership with Advent Health in the U.S.
This is that 50 hospital deal.
Yes, across 9 states. But here's the key. They aren't just selling them 5,000 monitors and wishing them luck. They are selling enterprise informatics.
Meaning?
They are effectively becoming the operating system for patient monitoring across the entire Advent Health network.
That sounds sticky.
Extremely sticky. That is the holy grail for a tech company. Once Philips software is running your patient workflow, displacing them is a nightmare. It moves the revenue from one-off hardware sales, here's a box, to recurring long-term service contracts.
Which is why the margins in this segment are climbing.
That's it. They're selling capabilities, not just plastic and circuits.
Okay, let's talk about the third pillar. Diagnosis and treatment. The heavy iron. The big scanners.
A bit of a mixed bag. Up 4% in Q4.
4% seems a little sluggish compared to the others.
It is, but you have to split it up. Image-guided therapy. This is the Azurion platform, the tech used for minimally invasive heart and brain surgery. That is booming.
Really?
Double-digit growth. Hospitals love it because it enables surgeries that get patients out of the hospital faster.
Which saves the hospital money.
Exactly. But on the other side, precision diagnosis, the classic CTs and MRIs, was flat.
Why flat? Is the market just saturated?
It's capital constrained. Hospitals are struggling with their own budgets. Buying a $2 million MRI machine is a big decision. But Philips is trying to break that deadlock with technology that lowers the total cost of ownership.
This brings us to the world firsts they announced. I saw something in the notes about helium, and as someone who doesn't run a hospital, I have to ask, why do we care about helium?
You should care. The Blue Seal magnet is genuinely cool engineering. So traditionally, an MRI machine needs a massive magnet. To work, that magnet needs to be super cooled to absolute zero. To do that, you need about 1,500 liters of liquid helium inside the machine. Helium is expensive, it's a finite resource, and it's tricky to handle. If the machine quenches, which is a rapid release of gas, it's dangerous.
I see.
So hospitals have to build a massive quench pipe to vent the gas outside the building.
Which I assume is a construction nightmare.
Huge.
Yeah.
It limits where you can even put an MRI machine. You can't just stick it in a basement if you can't run a pipe to the roof.
So Philips fixed this.
They launched the Blue Seal 3.0T magnet. That's the high power standard. It is helium-free.
No helium at all.
It uses a tiny amount, about 7 liters, sealed into the magnet during manufacturing. It never needs refilling. It cannot vent. No quench pipe needed.
So if I'm a hospital administrator, I can put this MRI in a room where I couldn't put an old one, and I don't have to pay for helium refills.
Exactly. It lowers the barrier to entry. That is how you sell into a flat market. You make the installation cheaper and the operation simpler. It's sustainability meets operational simplicity.
That is actually fascinating. And then there is the other buzzword. AI. Everyone says AI, but what is the actual clinical utility of the Verita CT scanner they launched?
Well, it uses something called spectral CT.
Break that down for us.
Okay, think of a standard CT scan, like a black and white photo. It shows you shape's anatomy. Is that a lump? Yes. But spectral CT is like a color photo that also tells you the chemistry.
Now,
It uses different energy levels to differentiate materials. It can tell you, is that iodine? Is it calcium? Is it blood?
that seems incredibly useful for a diagnosis.
It is. But usually, processing that data takes a ton of radiation and computing power. Philips is using AI to do the reconstruction instantly with lower radiation doses.
Though radiation is the holy grail, especially for pediatrics.
Right. They are running the radical trial right now to prove they can slash dose levels without losing image fidelity. If they prove that, it becomes the standard of care.
So the tech stack is solid. They aren't just resting on their laurels. They are actually innovating. Let's zoom out to the strategy. This was Capital Markets Day. They laid out the plan for 2026 through 2028. What is the headline?
The headline is profitability over growth,
Meaning what exactly?
meaning they are done chasing market share at any cost. The new targets are very disciplined. They are projecting mid-single-digit sales growth, think 4 to 6%, nothing crazy.
And the profit side.
They want their adjusted EBITDA margin to reach the mid-teens by 2028.
Mid-teens means maintaining this 15% level they just hit in Q4.
Consistently, year over year. And they want to generate cumulative free cash flow of 4.5 to 5.0 billion euros over the next 3 years.
That is a boring, mature, dividend-paying company strategy.
Which is exactly what investors want after the volatility of the recall years. They want boring. They want predictable.
But I noticed the guidance for 2026, the year we are in right now, is a little softer. They are guiding for margins of 12.5% to 13.0%.
Wow.
You just told me they hit 15.1% in Q4. Why the step back?
That's a sharp observation. 2 reasons. 1, seasonality Q4 is always the biggest quarter, so margins are naturally higher then. But 2, and more importantly, they're being conservative because of the macro environment.
I think I know where you were going. I read through the report, and I saw the word tariffs mentioned about a dozen times.
The elephant in the room, tariffs hit every single segment. Personal health, connected care, diagnosis.
So everything they make is getting hit by trade duties.
A significant portion, yes. And yet, and this is the most impressive part of the report in my opinion, they managed to increase their margins despite these tariffs.
How is that possible? Tariffs are a direct tax on your goods.
They pulled off a bit of a magic trick. They offset the tariff costs entirely through productivity measures and, well, pricing. They passed some cost to consumers and they cut their own internal costs enough to swallow the rest.
That is impressive. But here is my concern, and I want your take on this.
Yeah.
You can cut fat. You can maybe cut muscle twice. But if tariffs ramp up again, which, let's be honest, in this geopolitical climate is a real possibility, do they have any levers left to pull?
That is the risk. They have cut $2.5 billion. The new plan calls for another $1.5 billion in savings by 2028. But it gets exponentially harder to find those savings the deeper you cut without damaging the R&D engine.
Right. You can't invent the next helium-free magnet if you've fired all your engineers.
Exactly.
And then there is the legal book. Is the Respironics saga actually over? We talked about the billion-dollar settlement.
It's not over. The financial outlook explicitly excludes the ongoing U.S. Department of Justice investigation.
That is terrifying. Here is our profit forecast, assuming the U.S. government doesn't fine us another $1 billion.
It's a sword of Damocles hanging over the stock. They are paying consent decree charges and field action running costs every single quarter. It's millions, not billions, but it's a slow bleed.
So, to wrap this up, we have a company that has successfully pivoted operations. They are innovating with purpose helium-free, AI integration, stickier software deals. They are generating cash again. But they are navigating a minefield of trade wars and legal leftovers.
I'd say they have earned the right to be cautiously optimistic. They delivered on the delivery year of 2025. They proved they can chew gum and walk at the same time, growing sales while fixing the foundation.
The shift from crisis management to platform innovation seems genuine. But here's the thought I want to leave you with. Philips is betting they can reach mid-teens profitability through internal discipline. But in a fragmented world, does a global supply chain company actually control its own destiny anymore? Or are they just one tariff hike away from another restructuring?
That is the multi-billion euro question. They've built a better ship, but the ocean is getting rougher.
Something to watch closely. That's it for this deep dive into Philips. Thanks for listening, and we'll catch you on the next one.